Hello everyone, welcome to this session. In the previous session, we have discussed what are the factors affecting financial crisis, and we had discussed 5 key points, and the remaining one is the government fiscal imbalances. And this point is more relevant for developing countries and emerging market economies. So after completing discussing this point, then we will see the theoretical framework or the structure of how the sequence of events in the financial crisis in general. So coming to the this part, the government fiscal imbalances, especially when government deficit happen, that means government deficit, that is nothing but the borrowing requirements of the government when the government expenditure is greater than the government revenue, right. So as a result, that when the fiscal deficits keep on increasing over time, then that most governments, they raise the fund in order to cover up the fiscal deficit is borrowing from the market, and for borrowing from the market means mainly by issuing bonds, right. So that means if the government fiscal deficit keep on increasing, that means they will be supplying more and more bonds in the market, and there will be a fear, it will be keep on increasing, a fear will be popping up in a way that there is high possibility for default on government bonds. So normally we believe that government bonds are low risk bond, that the default risk is very low, but especially in developing countries and other emerging market economies, when this fiscal deficit keep on increasing, there is a fear of default on government bonds. It happened in several many countries as well. That means they were unable to pay back the debt that they raised through the bonds market. So especially emerging economies like Argentina, Brazil, Ecuador, Turkey, these countries especially face this kind of problems. So as a result, let us see what is going to happen if there is increase in fiscal deficit, that the government fiscal imbalances happen. So obviously that when there is this fear, that means government borrowing is increasing, their government is keep on supplying more and more bonds in the market, and sometime and the individual demand for government bonds may fall, right. So the individual investors and institutional investors also, they will respond by decline in the demand for government bonds. That means in another way, the riskiness of government bonds increases, and in one of the session we have seen that when the riskiness of bonds increases, so any particular bonds increases, is demand decline, right. So individual demand, institutional demand for government bonds decline, then in this case government may force financial institutions to purchase them. Especially in many developing countries, they have public sector banks, public sector financial institutions, and they will be forced to purchase the government bonds. Then that as a result, because if these institutions are forced to purchase government bonds, that means that may not be their right investment decision, right. That may not be their correct portfolio allocation of their resources. So sometimes they may have to distribute their fund in a way that they have to meet liquidity, profitability, all these factors, all these parameters they have to fulfill. But if they are forced to invest more in government bonds, then you obviously that that may not be their right investment decision sometime, and then as a result the balance sheets of banks will start deteriorating. So now recall what we have studied in the previous class session. That means when the balance sheets of banks deteriorate, then that the bank's net worth will be declining, and this will lead to the problem of adverse selection and moral hazard problem, right. This will lead to worsening of adverse selection and moral hazard problem. That is one. And second one is, if there is fear of default of government bonds, foreign investors, they also normally in general they also do invest in government bonds of other countries. Suppose India's fiscal deficit is keep on increasing, then obviously that those who has invested in Indian government bonds, they will pull back their money. That means capital outflow will happen, right? Capital outflow will happen. That is one. So that means who had invested in Indian government bonds, if they fear that there is high probability, the probability of default risk is increasing, default risk is there, and they will pull out their money, they will withdraw their money, and they will take back the money back to their home country, for example the US investor, right? Then similarly, normally what is expected, capital inflow, that also will decline. That means these both are in one same meaning. One means who are invested, they will take it out. Similarly, whatever the expected capital inflow, that also will come down. That means whoever is supposed to invest, make a new investment in Indian government bonds, that also will decline. So what would happen as a result? You know that as a result, because of this, when there is as a result of all of this, you know that the demand for Indian money, Indian currency, demand for domestic currency decreases, right? Demand for domestic currency decreases. So this decreases. So as a result, you know that exchange rate depreciation will happen, right? Exchange rate depreciation will happen. So increased fiscal deficit. So as a result of exchange rate depreciation, you know what will happen finally. When that is one. Similarly, before that, one more point, because of increased fiscal deficit, there will be a downgrade of sovereign ratings as well. So that means when one of the parameter that normally used for the credit rating agency, sovereign rating agency, is the fiscal deficit. When the fiscal deficit increase, they downgrade the sovereign ratings, that the government's rating will be downgraded, and as a result, again the same things which I mentioned here, the decline in capital inflow will happen. So the further outcome will be that the demand for domestic currency will decline, and exchange rate will decline. This also will depreciate. So that means when the exchange rate depreciates, suppose initially $1 is equal to 70 rupees, and suppose due to this, when $1 is suppose 90 rupees depreciation, and then you know that as a result, many firms who have borrowed from abroad, that means borrowed in from foreign currency, their repayment burden, the debt burden increases. Right now they have to pay more amount because the exchange rate is depreciated. Both the principal and interest income, interest payment, the burden of debt payment, repayment increases. That means again the balance sheet, it will affect the net worth of the firm. Right, again the problem is here. If the as a result of exchange rate depreciation, their debt servicing, that cost increases, that means liability increases. When liability increases, net worth increases. That means that these firms, many firms who have borrowed from abroad, they will be more vulnerable to the problem of adverse selection and moral hazard. So this is one of the reason how this would lead to the government fiscal imbalances, how this would lead to the financial crisis. This is stage 1, in fact, actually in the initiation of financial crisis. So that means the it have further effect the net worth of the firms. When it affects the firms then you know that the asset market effects, this kind of things would happen here. It will affect the asset side of the firms, and as a result we can see that this will lead to financial crisis. So we have discussed several points here, particularly we can see that 6 factors we have discussed. So maybe actually most time either of these or many of these will be happening simultaneously or alone or simultaneously happening. So any of this can happen, any of this can lead to can be the seed for financial crisis. Maybe asset market effects, we can see that if there is a supply side shock, that the energy price, that the supply side shock, for example the increase in the price of oil. So that means that would affect the automobile sector, and especially in the consumer industry who is producing the consumer goods and services, and they also will get affected. You know that because of that their sales, their level of the volume of sales will decline because the increase in the cost of production, and as a result you know that the dividend will decline and their stock price will decline, and this will lead to asset market effects, and maybe due to increase in interest rate, maybe due to some changes policy, sometimes due to maybe an unintended consequence of monetary policy, maybe suppose when they say that there is inflation, and as a result if they reduce the money supply, then interest rate can increase, or maybe these are some of the factor aspects. And similarly, balance sheet of a bank, maybe suppose government asks the firms to make prioritize lending, then as a result they may have more NPAs, and then there will be a deterioration in the institution's balance sheet, banking crisis. So what all these factors, either of these things can happen, it can lead to financial crisis. Actually these kind of things are happening often, but what the thing is that maybe it may be minor, maybe immediately the policy makers recognize it and they do some policy intervention, then it will be neutralized. So this kind of things are happening, but when it out of control, when it becomes significant, considerable, then that leads to financial crisis. So these are the factors that we discuss here. So in addition to this, the asymmetric information problem that we had discussed in the previous sessions, that the conflict of interest that is happening in the investment banking, auditing firm, rating agencies, these actually add further fuel to the financial crisis, in addition to the factors whatever that we covered until now. So in addition to this, the conflict of interest and asymmetric information problem, that also plays a crucial role. Actually the 2007-8 crisis, there are in fact these conflict of interest also played a crucial role in aggravating the problem. Now after discussing the factors that will affecting the financial crisis, let us now see what are the sequence of events in a financial crisis. Here we are going to develop a theoretical framework to understand the dynamics of financial crisis. So here we will see what are the stages, that is stage 1 by including the factors that we discussed, how this will lead to, that means how the financial crisis it starts. So that is the main objective in this session we will be covering, and in the next session we will cover to apply this framework to understand the crisis, financial crisis of 2019-29 and or more elaborately of 2007-8 crisis. So there are the dynamics of financial crisis. We can classify, put it into 3 stages. In the stage 1 we can call it the initial phase. Mainly there are 2 ways in which a financial crisis can start. One is called credit boom and burst. This is mainly because the mismanagement of financial liberalization or innovation leading to asset price and burst. So in this point mainly we will be discussing how financial innovation, or when countries engage in financial liberalization, that means the elimination of restrictions on financial market and institutions are happening. That means particularly when the economy introduces new types of loans or financial products, which is known as financial innovation, that in fact eliminates many of the financial market restrictions in fact. So in the long run, what is going to happen that in the long run financial liberalization promotes financial development and encourages a well run financial system that allocates capital efficiently, but in the short run we are going to see that is going to create some negative effect. So before we discuss this fact, let us see what are the other stage, and stage 2 is considered as banking crisis, and stage 3 is debt inflation. So let us see with stage 1. As I mentioned here, financial innovation is one of the response to avoid restrictions and regulations. In the long run is going to benefit the economy, because anyway these are all innovations. So in the long run we can see that we can anticipate that capital will be used more efficiently, but in the short run it can prompt financial institution to go on a lending spree called a credit boom. So that means the dark side of financial liberalization is that it can prompt financial institution to go on lending spree. That means lenders may not have the expertise or the incentives to manage risk appropriately in these new lines of business, and even with the proper management, credit boom eventually outstripped the ability of institutions and government regulators to screen and monitor credit risk and lending, leading to overly risky lending. So, as a result, what is going to happen after a period of time, eventually the losses on loans begin to mount, right, because when they are making loans to new lines and even giving loans to high default risk, that the high risk individuals and institutions, and eventually you know that losses on loans begin to mount and the value of the loans, and thereby driving down the net worth of the bank and other financial institutions. So, simply we can say that when loans increases, when NPS increases, then the net worth of the bank will decline. So, obviously bank will respond to cover up this loss, and you know that as a result many ratio, the capital adequacy ratio, leverage ratio, all this will get adversely affected, and then with less capital what they will do, these financial institutions cut back on their lending to borrower spenders, a process called deleveraging. So, they started because they realized that they are making losses on their loans. So, they try to cut back on their lending to borrower spenders. So, which is a process called deleveraging. So, as a result, the flow of fund in the financial system start declining. So, similarly another related thing is that as a result there will be asset price boom and burst. So, when the price here, as a result, when the prices of assets such as equity shares and real estate can be driven by investor psychology, that means the investment made by people is not based on the fundamental economic values, the economic fundamentals of that firm or the sector. Instead, that it will be driven more by the investor psychology, maybe because of mostly incentivized by the financial innovations as well, and then their values based on the realistic expectations of the assets of future income stream, that is based on their expectation. Based on that expectation they will be making investment. So, as a result, sometimes the value, the rise of asset price above their fundamental economic values is an asset price bubble. So, actually asset price bubble happen here because when the price is above, when the market price of an asset is above their economic fundamentals, then you know that when the market price of an asset is above the fundamentals, and after certain point of time obviously there will be a burst of this bubble, right. When the bubble bursts and asset price realign with the fundamental economic values, and then stock and real estate price tumble, companies see their net worth that is drop. Again they see that their net worth thus declines. So, then you obviously again you know that this asset price decline because of their, this is the asset price boom in the beginning, and when it burst, then the asset price decline, this would lead to decline in the net worth of the firm, and then the firms will be more vulnerable to again the asymmetric information problem, that is adverse selection and moral hazard. In addition to this, there will be increase in uncertainty in the economy also prompt in the initial phase. That means just after the start of a recession, suppose a crash in the stock market or the failure of major financial institution, that would increase the level of uncertainty in the economy. So, as a result, if there is more and more uncertainty in the economy, when the uncertainty is more, then when uncertainty is high, then information will be very hard to come by in a period of high uncertainty. Then this would lead to financial friction, that the financial friction increase, and which would further lead to the, again as we mentioned, that when the financial friction increase, the asymmetric information problem will increase, aggravate, and which will reduce lending and economic activity. So, these are all the factors that normally happen in the stage 1 of a financial crisis. Then coming to stage 2. So, before going to stage 2, this is a framework that we discuss here. So, here this is the stage 1, the stage 1 is this, stage 2 is banking crisis, then stage 3 is bank deflation. What we discussed so far is if there is because of the financial innovations. What are the point that we discuss here? The financial innovation, this is going to lead to credit boom, but after certain point of time there will be asset price decline because of the burst in the asset bubble. Then this would lead to deterioration in the financial institutions balance sheet. Similarly, another point that we discussed, that the increase in uncertainty, this also this will directly lead to aggravating the problem of adverse selection and moral hazard problems. So, coming to this part, when this was the first part, the asset price decline, then this will lead to deterioration in financial institutions balance sheet, then the net worth of the firm decline, and then as a result again the problems of asymmetric information, this problem get worsened. So, two ways, one is asset price and uncertainty. Finally, all this lead to aggravating the adverse selection problem. Then this would lead to further tremor in the economy, in the system. Because of this, the economy will enter into the second stage, which is mainly a kind of mainly characterized with the banking crisis. So, banking crisis, what we can see that due to the deteriorating balance sheets and tougher business condition leads some financial institutions into insolvency, which happens when their net worth becomes negative. So, here many firms who have borrowed from the bank, they are unable to pay off their loans. Then as a result, you know that the banks will be ending with many NPAs, non-performing assets, because many firms because of their financial condition deteriorate, they may not be able to pay back their loans. So, as a result, banks NPAs increase, that means banks net worth, again here banks net worth declines. So, what would happen if the banks net worth decline? As we have seen in the previous session, that means some banks they won't be able to pay off the depositors or other creditors, then some they will go out of business. So, let us discuss this point in detail, that banking crisis. So, that means when financial institution into insolvency, then what we say that many firms they will be unable to pay off depositors, and then as a result you know that the bank panic in which multiple banks fail simultaneously happens. Right, this is the point that we have seen in the one of the previous session, that exactly happen here. That means bank panic will happen. That means people will be running to bank in order to withdraw their deposit, because again the asymmetric information problem is there. They cannot really distinguish which bank is good and which bank is bad here, bad risk here. So, in this case, this is having a contagion effect. Source of this contagion is nothing but asymmetric information. And adding further fuel to this, you can see that when many banks see that there is a deposit outflow from their bank, so as a part of their liquidity management, in order to pay back their deposit, they will engage in banks distress asset sale. That means they engage in a asset sale, that is nothing but banks distress asset sell off, which quickly to raise the necessary funds. So, what would happen as a result? Because they are suddenly selling, they are making a distress sale of their assets. So, these fire sales of asset will further cause damage. That means it may further cause their prices to decline so much that more banks become insolvent, because they are suddenly they are selling in a distress condition. Then you know that distress sale, obviously you know that oversupply of assets, and obviously the buyers also will doubt what all their assets, maybe most of their assets will be loan resale, then the loan resale they will be getting less value, right? The price they are getting also will be very less, and they will be eventually ending up with lots of loss. And then finally this will lead to becoming banks insolvent, and resulting contagion can then lead to multiple bank failures and a full-fledged bank panic. So, this would lead to banking crisis, aggravating the banking crisis. Then you know that this sequence of events, if you read it in proper line, we can see that there will be fewer banks operating as a result. If there are only information about the credit worthiness of borrower, spenders disappears. right, and increasingly severe adverse selection and moral hazard problems in financial markets deepen the financial crisis and causing declines in asset prices and failure of firms throughout the economy that lack funds for productive investment opportunities. So, this is actually the full fledged in the second stage 2 financial crisis will be characterized with a full fledged banking crisis. Now, let us move to the third part in the stage 3. Here actually in the second stage we have seen this one, that banking crisis, and this again lead to further aggravate the moral hazard problem, adverse selection problem, then overall the lending declines. When the lending declines, then the productive the sectors which can make the best use of capital, they will be having deficiency of capital. It will be very expensive for them to borrow, and whoever is remaining in the market, bankers, they will be charging high interest rate. Then as a result, overall borrowing will become costly, and as a result the economic activity will decline. So, when the economic activity declines, we can see that there is the declining GDP, declining employment, and overall economy is moving to a kind of recessionary stage. Then this will lead to entering into the third stage, that is called debt deflation. So, here in the debt deflation we are going to see that unanticipated decline in price level. So, let us see how this would create problem. So, because of the economic downturn, there will be debt deflation. Debt deflation means again the further deterioration in firms' net worth because of the increased burden of indebtedness. So, the substantial decline in borrowers' net worth in real terms happen here, and it creates increase in adverse selection and moral hazard problems for lenders. And the point here is that the debt deflation mainly it happened because when the economic activity declines, then there will be an unanticipated decline in the price level. Right. So, that is the important point here. We need to see debt deflation. Then as a result, when there is unanticipated decline in the price level, then you know that debt servicing become expensive. The repayment of loan and its interest rate, that expenses increases, the burden, the debt payment burden increases, and this would lead to further lead to borrowers' net worth, decline in the borrowers' net worth in real terms. So, this again we have seen that all this would we had discussed this one multiple times. That means decline in net worth leads to worsening of adverse selection and moral hazard problem. So, in the long run, what is going to happen? All this lead to in the long run lending and economic activity decline for a long time. This is nothing but the stage 3 economy will be ending up with an economic recession. Economy in a recession, that means the volume of economic activity will be very low, and which would lead to overall decline in economic activity, that means low GDP, low employment, etc. So, these are all the 3 stages that we just now discussed, and in the next session we will apply this framework and all the factors that we had discussed in the previous session to understand the 1929 Great Depression and 2007-8 financial crisis in detail. And thank you, and see you in the next session.